Lecture 13 with Trend Setups Channels. In this lecture, you will learn about channels, what they are, and how they can be useful in your trading. You will learn also different types of channels and how they can be drawn correctly. A channel is when the price is contained within two lines. The upper line serves as a resistance line, while the lower line is the support line. What you see here is an uptrend channel. The upper line is drawn by connecting two swing highs, while the lower line is drawn across two swing lows, similar to the way single trend line is drawn. This is, on the other hand, represents a downtrend channel. The upper line serves as a resistance line, while the lower line is the support line. Whenever the price comes near the resistance line, it pulls back away from it toward the center of the channel. And when the price is near the support line, it bounces to the upside toward the center of the channel. All of these actions happen in this example within the main downtrend of the price. Although there are many indicators that used by traders to indicate levels of support and resistance, like curved lines that are based, for example, on moving averages, similar to this one shown here. But it's worth noting here that trades based on straight channel lines have higher predictive power and are more reliable setups than other indicators. Examine this channel here and look how the center of the channel always acts as a magnet where the price is attracted to it from both lines of the channel. Because the price does not go in straight lines, it's very common for price actions to be contained within channels, whether the channel is diagonal in case of trending market or horizontal in case of trading ranges. Channels are very common and it can be spotted frequently on all time frames. Look at this chart and notice the up channel here that has been followed by this down channel, then by an up channel, and then a down channel, followed by this horizontal channel. However, eventually at some point, the price will break out through either one of the channel lines. I mean, either to the upside or to the downside. In any chart pattern that show price contained within a channel formation, like this horizontal channel shown here, traders must expect that a breakout of the channel, like this break, is just a matter of time. However, most breakout attempts fail, and the price is then pulled again inside the channel. Look at these failed breakouts, whether it was an attempt to break to the upside or attempts to break the support of the channel. You must know that most of the time breakouts fail, especially early attempts to break the channel. But when finally the breakout succeeds, as the case here, a new trend to the upside or to the downside will emerge, depending on the direction of the breakout. The main job of the smart traders is to distinguish between the fake breakouts, like these ones, and the real breakouts, like this one. This is very important to avoid being trapped by the market when you try to trade a breakout that turned out to be a fake one. Channel lines are not always parallel. They could be divergent lines in case of widening channels, or most commonly convergent lines in case of narrowing channels. Triangles represent a consolidation phase in the price action and are signals for a breakout, and the breakout is usually in the direction of the previous trend. Generally, if the two lines are not parallel and are convergent, then the channel is called a triangle. Triangles can be symmetrical, ascending or descending. The pattern that is shown here is a symmetrical triangle. Symmetrical triangle can be recognized when the triangle is not trending and it is formed by two intersecting lines with similar but opposite slopes, similar to these trend lines here. The downtrend line here is the resistance line, while the uptrend line here is the support line, and the price is consolidating between these two lines. If the triangle is trending up, it is called an ascending triangle, like this pattern, and it can be recognized by two intersecting lines. The resistance line is nearly flat, as you can see here, while the support line is trending up. This ascending triangle pattern is considered by technical textbooks as a bullish signal. However, because triangles represent price consolidation, I often recommend traders to deal with them like trend continuation signals, where the direction of the breakout will often follow the trend preceded the triangle. But as we said earlier, channels, including triangles, are considered range trading, and smart traders should expect any of the two lines to be broken, and the traders must manage their risks based on this fact. When the triangle is trending down, it is called a descending triangle. It is characterized by two intersecting trend lines, as you can see here. The upper one, or the resistance line, is trending down, while the support line is nearly flat. The breakout is expected to be to the downside. However, the breakout from this pattern could be to either side of the channel. Always make your options open to the idea that the market can and will do anything, and be prepared to trade the breakout once it happens, and do not trade based on rigid previous beliefs. This would be the end of this lecture, and in the next lecture you will learn more about channels and the best ways to trade different types of channels.